Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? It's August 9th. I'm Frank Curzio, the Wall Street Unplugged podcast. We break the headlines and tell you what's really moving these markets. Because this podcast may be worth a lot of money, so be sure to save it, especially if I die, which you will know if that happens while you're listening to this, because I'm taping this late Tuesday and early Wednesday. I'm going to get surgery, get my hip replaced. Got my right side, my right hip replaced already. It was the greatest surgery ever, which means this surgery is going to be the worst one ever. I don't know. I'm not superstitious or anything like that, but it went so perfect the first time. I felt like the Bionic Man. I could just grab the rim now, and then basketball, which I never was able to do, and rotate more in golf. And now, they said 5 years from now, the left side's going to mess up, and you're going to need that and stuff, and you're going to get that hip replaced, and that's where we're at. So we're getting that hip replaced. I've been in a lot of pain for the past couple months and sleeping and stuff like that, but I'm getting that done, and hopefully you'll know if everything turned out okay. But I'd say your prayers, but you don't need to, because I'm already going to be out of surgery, whether it's good or whether it's bad. But if anything does happen, love you guys. If you're a lifetime member, that sucks for you. You could sue my doctor. That was great getting you guys on Lifetime, huh? Hoping that I live forever. Hope I do. Not forever, but a long time. See my kids grow up. So, yeah, interesting. But I wanted to tape this and get this podcast out. Daniel will be doing tomorrow's Washington Football Premium by himself. The recovery is usually pretty quick. I should be at the hospital the very next day. I don't know if I really want that. I'm thinking about it, so I'm going in early. But do I really want to come home the next day? I'm not sure. If you think about it, you're laying in bed, hanging out with some nurses, watching TV, getting a great sleep, or go home right away. Listen to my wife yell at the kids, probably. My daughters fight. Gonna watch TV and put the TV on while I'm on the couch, laying down. Can't do anything, and everyone's saying, "Oh, is this what you're really watching, Dad?" You have to deal with any of that. Maybe I'll take a week. Just check in and say, hey, you know what? It still hurts. And none of that, you get free drugs and just hit that thing and go right to sleep. That's awesome. I don't know. I'm debating whether I should come home right away or not, but I should be home the same day. And I'm just joking about my family. Halfway joking. Kids can be real pain in the ass. Nobody tells you that, right? Kids are the best thing ever. Man, it is. It's great, but whoa. When I talk about going crazy, you can go crazy. Try having girls that are going through, the teenage years. That's interesting. But hopefully everything goes okay with the surgery. I will tell you this, which is amazing. So last time I got the surgery, I don't remember paying that much out of pocket. This time I'm going to be charged $8,000 out of pocket for a $40,000 surgery. And I was like, holy shit. Considering that I thought we had pretty good insurance on my corporation. Not only that, but they raised the prices like 15%, I think. So, they raise them every single year. It's a fortune. The premiums are higher. So I started doing a little research on it, and it was saying the proportion of premiums with increases in 2022 was 36%, a higher rate than any other year since 2005. Because among premiums that went up in 2022, the average increase was 8%. Year over year, maybe. The 15 states reported double-digit percent increase in premiums in 2022, up from 12 in 2021. So, again, this is happening while employee costs, at least mine, are up tremendously. If you look at inflation, they say, well, healthcare costs are coming down. Somebody please tell me if your healthcare costs are coming down, because mine aren't. But now that my deductible is met, I'm thinking of maybe getting a bunch of MRIs on every body part that bothered me for the past 10 years since I'm 50 and it's starting to hurt since I play sports all my life. You just go to the doctor's office and hang out every single day and ask them a million questions. I don't know. So deductible is now met, but $8,000. I'm curious to hear what you guys, surgeries, and is it that crazy? I mean, holy shit, right? That's insane. What a business, healthcare. What a business, right? taxpayer dollars, all government funded. It's awesome. It's such a great business. Insurance is the greatest business, especially when you make the government pay for it. Like when you have to get insurance no matter what. You don't really need life insurance. You could get it. It might be good for you. It depends. Everyone says, you need it, you need it. Well, if you live for 30 years and after you first got it and you kind of didn't need it, or maybe you didn't need it, I don't know, depends, but it's debatable. But you look at car insurance, a necessity. You look at all this stuff that's forced on you with insurance, and you wonder why Warren Buffett's a billionaire, because that's how he made his money, right? Leveraging the insurance company and the pools of money that almost never get paid out. Sometimes they do, but most of the time they don't. And then the reinsurance companies, which is the biggest scam in the world, right? It's insurance for insurance companies, which basically you're seeing every hedge fund take over or start their own reinsurance companies. You almost never have to pay out insurance, but this is insurance for the insurance companies, just in case. That's what reinsurance is. So they take those big pools of money, all the hedge funds, and then they invest it and make more on their return. Again, that's what Warren Buffett did. It's not because he bought Coke and everything. He leveraged the shit out of his company and did very, very well because he's a great investor. But the reason why it got so big is the leverage part, which people don't talk about. They're like, oh, you buy Coca-Cola, you hold it every single year. No, it's good to leverage the shit out of that, and good for him, right? So insurance is the greatest thing on earth for these companies. It's why those companies make money hand over fist constantly, and again, great business to be in. But I'd like to hear from you guys, frankcurzresearch.com, about insurance. Unless I die, you don't have to email me because I'm not going to get it, but we'll see. Anyway, let's talk about some of the things that are happening, right? We saw more debt downgrades, which is very serious. And this is from individual banks, and saying a lot of bigger banks got put on notice. So when I see that followed by the Fitch downgrade, that's what pushed the markets down on Tuesday. And I'm starting to not find any reasons to see why stocks are going to go much higher. And I'm not calling for a market crash, but there's a big difference in some companies. When I'm seeing a company like Apple that's gone up almost parabolic, right, over the past 9 months, the exception of the past couple of weeks that they reported earnings. I mean, this is a company whose stock went up considerably. And when I say considerably, you may be like, well, it's up 60%. This is a company that added like $1 trillion plus in market cap. For a company that saw sales decline 3 quarters in a row, year over year, right, compared to the year before. When I look at AMD be under the umbrella of a company that beat earnings estimates, part of the 80% of the companies that beat earnings estimates, they're under that umbrella, yet earnings declined, 46%, sales declined 22%, but they beat the estimate. That's all that matters. And the valuations on some of these names are insane. Should they deserve these high premiums? I don't think so. But you may say, the economy is it getting better? Because we just saw credit card debt, and that was released on Tuesday, hit $1 trillion for the first time in Q2. Look at bankruptcies, foreclosures, delinquencies, all rising. So look at credit card debt, which is 30 days or later, rose 7.2% in Q2. That's the highest since the first quarter in 2012. I was watching as those results were released, and so Steve Leisman and CNBC, quick to point out, again, no worries. Still better than 2008 levels. And and then what happens when we pass 2008 levels? You're going to say, don't worry, that they're higher than, Great Depression levels. I mean, is that really what we're comparing it to? Because it's very misleading, because this data is going to continue to get worse and worse and worse. That's what the Fed is trying to achieve by higher interest rates. It's not this, one-time event and the banks, we had the banking crisis, the recent banking crisis, right? Selling treasuries and couldn't wait for them to mature, and then, forced Silicon Valley, who was over leveraged. Okay, the Fed just writes a check and everything's fine. This isn't like someone writes a check and everything's fine. This is a different market. This is interest rates going higher. That's okay for the first 6 months because the government decided to put the pedal to the metal and continue to push out more and more money into this market, which is unexpected, right? What happened to quantitative tightening? Well, let's just hold up a little bit. Now we'll go into election year. What do you think is going to happen? You think they're going to raise rates? No, they're probably going to try to start lowering them if they can, but they might stop. We're near a top here, maybe one more rate hike, but make no mistake, guys, that's not a good sign. We're going to be staying at these levels for a long time, but even when we start lowering, If you look at the past hiking cycles, every time that's not the pause, when we started lowering is when the markets really crashed and they came down. Because it's a signal that you're lowering them because the economy is not doing good. And you're going to see that eventually. That's what these rates are doing. You're going to see that in housing. You're going to see that across the board. You're starting to see those cracks. And bull bear is back to his cycle high. You look at Berkshire, reported operating profit, which was at a record, and the stock's near all-time high. But Berkshire in Q2 sold 8 billion more stocks than they bought. This is Buffett, right? Also, big champion of buybacks, bought back less, much less of their stock than usual, meaning that maybe they think it's a little it's relatively high. But if you look at their cash balance went much higher than expected. Okay, they sold more than bought, so not, if you're a follower of Buffett and believer in Buffett, which you should be with his track record, seems like he's stockpiling a lot of cash, waiting for the right opportunity for stocks to come down to purchase them, but he's not really being aggressive now. I don't blame him where valuations are. Look at the yield curve, the 2 to 10-year yield curve. Just watch CNBC. They mention it like every 5 minutes now. It's steepening. Not good when we see it rise to these events. This is, when it rose to these levels, what do we see? The banking crisis, usually things crack when we start seeing these levels go higher or steepening. Loan and credit tightening, absolutely surging. You look at the SPR for crude, lowest level since 1985. Good for oil stocks, which we have a lot in our portfolio now. Supposed to start replacing that, remember that? But are they going to do that at $80 a barrel going into an election year, right? We have to factor in the election year. We have to. Because things are going to be different. They're really going to have the Fed tightening and raising rates. So going to have the economy look better than what it really is doing. Outside of jobs, outside of wages. I mean, you can point to numerous indicators that show that things are weakening. Again, we're all over the place. I can give you 10 indicators that show weakening and recession and 10 that show that, we should be raising rates because inflation is going higher. But that's what happens when you inject trillions and trillions into the market because no one knows what the hell's going on. They pretend. Pretend we're going, the bullish thesis is that the Fed's going to stop raising rates and stocks are going to go higher. Well, they haven't stopped raising rates and stocks are higher, but pat yourself on the back if you said that because you're right in terms of where stocks were going. Your thesis was wrong. What does that say going forward? Think the market's going to go even higher? If you really want to see how dangerous this market is, look at the equity risk premium, which compares the risk-free rate and a potential return on the S&P 500. So in short, this shows how expensive stocks are. And when you look at this thing, I mean, it's down to levels showing that the valuations, that the market is more expensive at any other time than over the past 20 years. Even more expensive in 2007, 2008, when the credit crisis hit. So it's then COVID. So it's taking like the risk-free rate of what you could earn without even buying stocks compared to what the S&P 500 is expected to generate over the next 12 months. Again, that equity risk premium is a big deal. And that's why I say this is one of the most dangerous markets I've ever seen. Much more dangerous than other times because other times you just pulled your money out. Okay, COVID, I'm pulling it out. No way. Holy shit, I'm scared. Credit crisis. What the hell's going on? AIG is involved. GE. All right, I'm pulling my money out. I'm out of here. Now you get punished for pulling your money out because stocks going higher and higher and higher. That's why it's dangerous. And you have to be careful. It's not necessarily that the whole market's going to come down. It's just we're very expensive levels, and I'm struggling internationally. China data, you see the import-export data, horrible. I'm struggling to find catalysts to justify where so many of these stocks are trading. On a flip side of that, I'm also finding lots of ideas that people just hate, and they hate it for a long time. One of those names are in Curzio Research Advisory we just recommended. But guys, stock picking and getting into the right names is essential. I can't tell you how many names over the past couple of days that reported earnings that you see down 15, 20%. And they're still expensive. You look at the market being like, wow, your portfolio, and it looks like it should be doing better with the NASDAQ up so much. Are you? Do you have access to Disney? Do you have exposure to Disney? Do you have exposure to a lot of these names that aren't doing that well? Oil stocks underperform. Now they're starting to come back and look great because oil prices are probably going much, much higher from here, most likely. There's different areas of the market. There's different stocks you need to be in. Stocks that are growing earnings much faster than the overall market. Stocks that are growing sales much faster than the overall market. You'll find lots of those names. You have to dig, but you'll find them. Companies that I've seen that generate tons of free cash flow. Don't worry about dividends, because you're seeing this big shift to paying dividends into buying back stock, and that's what you want to see, because that's the floor that you're going to see that you need to buy in these stocks, where if the overall market comes down, that's when they're going to be buying back this stock, these management teams. See if you can find companies, which there's a list of companies, you'll see it in Curzio Research Advisor. Again, last few recommendations, companies buying back more than 7% of their float. That's huge. Used to have that floor when interest rates were 0 for 10 straight years. Just buy the dip. Money's free. You don't have that anymore. So what's the floor? What's to stop this stop? What's to stop Apple from going down 30%, which is insane. Apple going down 30% is insane, but yet it's going to be trading at a market multiple if it does that. It's going to be trading at 20 times earnings. And you know what? At 20 times earnings, it's still going to be growing earnings and sales slower than the overall market. So if you see something like that with Apple, where they're tied to headsets, and I don't know if you've been listening to calls about headsets. Holy shit, Micron, you listen to Skyworks, you listen to, all companies across the board. Apple's kind of like, oh, this is great, and we have, more headsets that are active because you're giving them away for free. Of course. Buy one and we'll give another one to a family member, right? This way you can get the services and the cloud and all that stuff on it. But yeah, you get more active phones. But yeah, this is an iPhone company still. They have lots of services. It's not iPads. Not anything else. It's not AI. And Microsoft came out in their quarter a couple weeks ago and just said, look, we're not going to see anything really, not the bottom line, but the top line from AI, meaningful, for another year plus. And this is a company that's spending, tens of billions of dollars on AI? Would you say it to every other software company that's up 300% based on just putting AI in your name or mention it on every single call over the past 12 months? What's to say for those companies? How are they going to generate that kind of revenue? Those expectations. The valuations need to be fulfilled. When you have expensive stock, it needs to be fulfilled. You need to see earnings growth. You need to see sales growth. You need to see that. Or eventually you're Disney. Eventually you're Ford. You got to put up the numbers. You can't just say what you're going to do. You get away with that, especially in a bull market. In this market, you don't. You got to put up the numbers eventually, and a lot of these companies are having difficulty putting up the numbers. You'll see earnings go a lot higher because they're cutting costs, but sales are not really going higher. They're actually declining year over year for S&P 500 companies on average. Sales. Yeah, the Walmart's doing great. That makes sense. The McDonald's doing great, right? Both of those companies, lower priced goods, huge pricing power. Ability to raise prices. Not all companies can do that anymore. But stock picking is going to be extremely, extremely important. Focus on stocks that are cheap relative to the market that are growing faster. You'll find a few, especially in small cap land. But other names, especially names that have been driving this market higher, and Meta and Google and even Amazon, those three companies are much different in terms of buying them or selling them right now. But if you're looking at all those companies that went high, they're different from Tesla, where margins are getting crushed. Microsoft, driven on AI, saying, hey, it's not going to be that big of a benefit. And also how cloud growth on a percentage is slowing, which is their core business. Just amazing. They have 6 different divisions, and every division beat by just a hair. Perfectly for Microsoft. Amazing. No manipulation of earnings there. Don't worry about it. And Apple, who's seen a slowdown in mobile phones. And that's been echoed throughout everywhere. Look at the exports coming out from Taiwan. Down tremendously. Is that not the ultimate sign, right? Taiwan Semiconductor, the biggest maker of chips in all industries. And showing you that, hey, we're not seeing the growth that everyone's expected, or the economy not doing that good. Again, I'm not saying that everything's full, but I'm struggling to find reasons of, hey, you know what? The market's going higher and things are great. That's what we heard last week. Right? We heard that last week and the 3 weeks before. The economy's turning. We're great. We're fine. It's so amazing how sentiment changes when stocks go higher and everyone's happy. Now you listen, everyone's like, whoa, 2-3 straight days of Market's coming down. Now you're seeing downgrades from the credit agencies, which again, I agree with Fitch. How don't you downgrade? How could you say the U.S. is still in AAA standing today compared to where it was 2 years ago, 5 years ago, pre-COVID, whatever? I mean, you can't say that they're a much worse situation than they are. Okay, AA plus is a great rating. But to be pissed about that, or you really think things haven't changed? 1 trillion interest payments? No sign, no plan in place to lower our debt. 33 trillion. Unlimited spending on climate change regardless of the science. Give me a fucking break. And they busted Fitch's balls on this, on that call? Are you kidding me? Then Moody's comes out again, put a lot of big banks on watch for credit downgrades. A lot of big names there. It's Truist, Northern Trust, I think it was. It was U.S. Bancorp, State Street. A lot of big names. I mean, if you're putting them on credit watch, what's to say for the 4,000 community banks? How can it be 4,000 community banks? It's impossible. That's like having like 7,000 candy bars to choose from. I mean, eventually it's chocolate and whatever you throw in there. One will have peanuts, one will have corn. Eventually, you're just going to duplicate the shit, right? I mean, how can there be that many? And with higher interest rates, give me a break. You're going to see a lot of those names get crushed. I don't want to say another bearer of bad news, but you have to buckle down and be careful. Be careful here. It's a dangerous market. You're looking at oil looks good. There's pockets within software that look good. Yeah, but not every market is again, when you're looking at specific sectors within technology, is AI the big growth engine? Yes. See how NVIDIA does, but, with earnings, but it's tough to find these massive growth markets within what's going on because they're seeing so many declines across the board now. Like, things are just pulling back. Even the restaurant sector, outside of travel and leisure, is still very, very strong because people, instead of spending on discretionary items, they're going out even more. Remember, we're still coming off COVID. We're only a couple of years. People have taken maybe 1-2 vacations. They want to get out there with their family. 2 years of lockdown, we realize how important it is to get out there and talk to people. And how much we were lied to about all this bullshit. You need to stay in. We're going to kill somebody. If you don't get the vaccine, you're the devil. You're killing people. You're the one that's killing people and transmitting. Oh, yeah, you get the vaccine and you can still transmit COVID. Oh, wait. Man, it's so funny, the data coming out on COVID. Holy shit. Doesn't matter, though. I guess nobody cares. Nobody's ever going to get fired in the government, right? For lying. Doesn't happen. But I think the whole wild card in this is the election coming up. And what's the government going to do? Because if they continue to flood the market with cash, one, we're going to see the negative effects of that, where inflation is going to go higher and continue to go higher. That means they're going to have to continue to raise rates. Or do they continue, I don't know. I really don't know. I mean, if I'm looking at the election year, what they could possibly do? They want to try to keep oil down, so they're not going to replace the SPR. So oil prices, they're going to try to get lower. I don't know if they can. Gasoline prices, by the way, are at 10-year highs if you take out COVID. Just take out COVID because you got this big up and down. Some companies benefited tremendously and some haven't, and then they came back. But if you take out that 2.5-year crazy period of $11.5 trillion being injected. Take that out. And even when you're comparing stocks, compare now until like the end of 2019, before COVID, those are good comparisons. But if you look at gasoline prices and you take out just that part with COVID that, spikes and first it went down, then it spiked, but we're at 10-year highs. It's going to hurt people, it's going to hurt consumers. Like, they can afford that, along with student loan debt that they're going to have to start paying again. Is it 43 million Americans, $400 a month on average? They took surveys of these people and what they're cutting back on and how many say they can't pay that right now based on that demographic or the age. There's a lot of risk out there, guys. For a market where some of these stocks are trading at all-time highs, where Berkshire deserves it. Walmart deserves it. Does Apple deserve it? Really? Does Microsoft deserve it here? Because they're saying AI. Tesla deserve it? The crazy multiple? Again, you have to eventually put up the numbers, and when you're not, and now you're having this cycle change, we're going to see slower economic growth, which the Fed is intent on doing. But again, the wild card is how much, which the government controls the Fed, the president controls the Fed, and they hire the Fed. So, again, direct link, and it's always been a direct link, but much more over the past couple of presidencies. How's the Fed going to react going into an election year? And you see what they're doing right now, right? In terms of doing everything they can. I don't know why they don't want Donald Trump to run. I mean, their numbers are great in terms of head-to-head with Biden, but yet head-to-head with Biden with any other candidate, they lose. You'd think they'd want Trump to run instead of just going after him on so many bullshit charges. More of this, right? That's what we're seeing in politics in Washington. So it is a wild card going into next year. But just know it's a very dangerous market. You need protection. You can buy long-dated puts. We've done it through Money Flow Trader. I've pushed the crap out of that because of moments like this. Just be careful. I mean, you saw this earnings season, especially the past couple of days. A lot of these names, on average, the first time what we've seen this earnings season, right? With the bullshit number of the percentage of companies that beat earnings estimates, right? It's a bullshit number because they revised significantly lower and it's easy to beat. But this is the first quarter we've seen, probably in about 6-7 quarters, where the average usually where they beat expectations is around 70-73%, right? For the S&P 500 companies, 73% of them usually beat analyst estimates. Now we're at 80%, but this is the first time we've been over 73%, where even though that many companies are beating the earnings and sales estimates, the average company is going lower after they report, which is saying that a lot of this is factored in and the gig is up. We know that earnings year over year are down, sales are down year over year. Again, a company like AMD, hey, we beat earnings and sales estimates, but yet should your stock be trading that much higher considering earnings? I mean, let me take a look at this. Curious to see AMD right now. Give me a second here, guys. So, look at AMD. I want to see where it's trading. Because usually it should be a function of sales growth and earnings growth. Usually it's a function of that. So let's see. This is a stock that's trading at 113. It was 54 at its low. So it's trading, again, it's trading off its highs a little bit of 130. I want to see where it's trading. So it's trading at 38 PE. So based on the 38 PE for AMD, a company that is part of that 80% that beat their earnings and sales estimates, right? They beat the analyst estimates. This company should be growing sales by at least 10% and earnings by at least 15% annually. And earnings declined almost 50% year over year. Sales declined more than 20% year over year. That's how crazy this market is right now. So be very, very, very careful, especially companies that are heavily debted. They better be growing. Rivian has a lot of debt, but they're growing like weed. That's fine. Other companies, another company I almost recommended just has massive debt where their payments have gone up like $10 million simply because interest rates have gone higher. You have to be careful. They have a lot of debt. Companies are sitting on a lot of debt. It's going to be tough for them. It's going to be tough for them to restructure that debt. They'll be able to restructure it, but not at great rates. We'll see. It's not as easy to raise money in this market. Again, you're turning that faucet off. It's a different market. So be careful out there. It is a very, very dangerous market, but it's also a market, if you're smart, you can make a lot of money in. You just have to know what companies to invest in. The key, which has not been the key for a while and is boring as shit, is having good balance sheets where companies, hopefully they're not increasing their dividend because dividends are used to entice investors to come in. You don't need to do that when you get a 5% risk-free. In other words, Verizon, whatever yield it is, 5-6%. I mean, you used to buy it and say, okay, at least I'm getting 5-6%. Hopefully the stock could do okay. I don't need that 5-6%. I can get that risk-free. So I'm buying Verizon based on Verizon and what they're doing in the future. You're buying the stock now. So instead of using that money to increase your dividend, which you're competing against something that is risk-free, which is a higher rate, start buying back your stock. And you're seeing that trend, S&P 500 companies, for the first time, you're seeing it's called that dividend yield or buyback yield. The buyback yield is much higher now. Companies are using that money as a portion, more than 50% to buy back their stock and spending less on increasing their dividends, which is a good thing. Focus on that because good balance sheets thrive in these types of markets. Because when the shit hits the fan, all leveraged companies go down, even though they have good businesses. You have the companies that are going to pick up the pieces, and those become the industry leaders. We've seen it dating back 100 years. But more recently, look at 2000. Look at the credit crisis. The survivors through that, and the credit crisis might be a bad example because every bank should have went out of business outside maybe JP Morgan. But the government bailed them out and said, okay, everyone's cool. GM's okay. AIG's fine. But the tech bubble, you didn't really have the government injecting trillions of dollars. So you saw a lot of really good companies just leverage themselves. And when the shit hit the fan and NASDAQ declined tremendously over a 3-year period, in 2000, 2003, a lot of companies went out of business. And who were the survivors? Amazon, Microsoft. Holy cow, look at them today. Getting a bunch of those. IC. And, good 15, 20 companies that survived that just thrived, right? And that's where you want to be in this market going forward. The companies with the best balance sheets. And also make sure that they're growing sales and earnings. You have to, especially at these valuations. So be very, very, very careful in this market. It's crazy times. And again, if I'm wrong, it might not matter, especially if I don't make it through my surgery. But I'm not nervous at all. I'm happy with my doctors. Different doctor than performed it last time. But, all should be okay. And hopefully I'll be back on my feet pretty soon, pretty shortly. A couple of days. I'll let you guys know, let you know everything's okay and send out a couple of emails. If you want to send me personal checks, you can wire money directly, right, to me. I'm always accepting gifts. I'm kidding. Don't send me a dime. I'm joking. Okay, in case the SEC is listening. The wonderful SEC that doesn't do anything anymore, right? Especially within crypto. We'll see about that. But questions, comments, sure to send them to me and to Daniel, FrankCurzResearch.com, DanielCurzResearch.com. Daniel will be taking over Wall Street Unplugged Premium and also Frankly Speaking. So you have a lot of fun with that, which should be pretty cool. But again, questions, comments, feel free to email me. Thanks so much. Have a wonderful few days, and I'll report back to you guys soon. All right? Take care.